Good morning, Armor Insiders. Welcome to the morning meeting. Thanks for joining me. Let's talk about the stock market, what happened yesterday, what we think the market's going to be doing going forward, and how we're going to react. We're going to discuss the relationship between bonds and stocks. It's always a good one at these times. So I'm going to share with you a series of chart patterns that I think paint a picture that puts capital preservation at the top of the list, replacing capital appreciation. So shots across the bow yesterday, time to make sure you know where your stops are and how to protect the capital that you've been able to capture since the risk monitor turned green on the 2nd of November last year. So we're just going to walk through step by step what I did with our portfolio at the Armor Report, Armor Investing, how I changed my portfolio, the cash I have on hand, and then what I'll be doing going forward. What are the key things we'll be looking for between now and the end of the week that will determine whether or not I'm raising more cash, getting more defensive, or I start putting that, some of that cash back to work. So let's go take a look. You've heard me say on this desk many times, debt leads equity, bonds lead stock. It's always been like that. It always will be like. Credit investors are more attuned to the heartbeat of what's really happening in financial markets, and equity investors sometimes can just wile e. coyote right off the cliff, not paying attention to anything until all of a sudden they look down and you get some real aggressive selling. Take a look at the following three charts. This is the long-dated Treasury bond, okay? These are Treasury bonds. This is the rally in Treasuries that helped confirm the risk monitor green signal, which starts back here, okay? So Treasuries right in here, risk monitors turning green last year. Remember that? Every single index looks great, and Treasuries. Treasuries are rallying. That means rates are going down. The market's pricing in the end of the rate hike cycle. What you're looking at now should be fairly obvious. I can blow it up if you want to make it a little bit easier, okay? Is a failed breakout. In fact, we bought this and made some money on that, but that was a perfect 3-bar reversal. We talked about that on Treasuries. It's Treasury bonds, okay? Failed breakout above the 200-day moving average. So Treasury bonds failed to break out above the 200-day and immediately broke down below not just the 200, but also the 50. And with yesterday's action, took out the lows and this key white line going back to 2022. Treasuries are down again this morning. Treasuries are now in a downtrend, trading below all key moving averages. Bonds lead stock, okay? Let's go look at corporate bonds. It doesn't get more clear than that picture on investment grade debt. That is a pennant breakdown below the 50-day moving average, challenging the 200-day as we speak. Let's go look at what Wile E. Coyote is doing. Straight up, no regard for what debt's doing. There's debt breaking down below key moving averages and breaking down out of a pennant. Okay, if the market wasn't Wile E. Coyote off the cliff here, I would say to you, okay, Treasuries breaking down, debt breaking down, market going sideways, not a big deal yet. We'll see what happens. But when equity is priced to perfection, you can't have debt breaking down like this. It makes it very dangerous to be an equity investor. And we saw that yesterday. Let's keep going on this rogues gallery. Let's finish off with high yield debt, which trades closest to equity. You can see what's happening. Finishing pennants. Pennants are great if they break out to the upside. They're just as great if you're a short seller when they break to the downside. Meanwhile, Wile E. Coyote is doing that. So what I'm suggesting to you is that the time is now to defend capital. I hope I'm proved wrong. I hope the market rights itself. Treasuries hold up here in reverse. And the weekly close on the debt markets are back up, holding above moving averages. Okay, great. By Friday, I'll be adding more capital back into my portfolio. But yesterday, without a doubt, was a shot across the bow. And those shots are being fired by the debt players, which is very disturbing for anybody in the equity market who's been running money for over 30 years. Not even 30 years. Anybody who's been running money in equities and understands the relationship between debt and equity. You can have a divergence for a while. You don't just sell things because there's a divergence. But when you have this exaggerated move in equities to a CPI number that is kind of ridiculous, it tells you something else, something more nefarious is going on in the market. CPI was slightly hotter than the street wanted by like 0.1%. The Fed said at the last meeting, we're not lowering rates in March. The market refused to admit it and continued to price in possible rate cuts in March. The CPI number was the nail in the coffin of that idea. And it took all of that expectation of rate cuts in March off the table, as it should. The Fed already said they're not cutting rates. So bottom line, is this just a tremor? And that unbelievably unsustainable uptrend in equities can continue? You don't think it's unsustainable? Take a look at this chart just to put it in perspective. That's like an unbelievable vertical move and momentum. That's totally unsustainable. That's an index, guys. That's not an individual stock. That's an index. It's trading and crawling up the third standard deviation line above the 200-day. You almost never see that in an index. Look, I'm the first to ride it as hard as I can when there's bull and it's running and it's mechanical bull. I'll keep riding it. But there was a shot across the bow yesterday, and the guys doing the shooting are the bond guys. And that should make any equity investor very uncomfortable. So let's see where we are on Friday. Let's see what the weekly close is. I'm always willing to put capital back to work if the market rights itself. But for now, I'm in risk off mode. We raised a lot of cash yesterday, and I shift a lot more attention onto day trading the index. I'm happy to get out there and put capital to work, capture whatever upside I can, but I do not want to sleep on a large equity investment at this stage in the cycle. I look forward to working with all of you on the desk. 9:30, we'll get started. Everybody who can join us, we'll be trading the indexes together. I will not be adding anything new to the portfolio. I've stripped down to the bones that I'm willing to carry right now. I may be raising more cash today, depends on what the market does. We'll be watching treasuries closely. For those of you who can't be on the desk, there's 3 ways to appreciate ARMOR information. Get the ARMOR report, this video and the captain's log before the market opens. Do it yourself. Join us on the desk as an ARMOR insider. Do it with us all day. Or if necessary, we could talk about managing capital together. Direct message me, give me a phone call. We'll see if the relationship makes sense. Okay? Everybody have a wonderful trading session. No matter what you do, at the end of the day, remember, be the smart money. Take care, guys.